In early 2025, many New Zealanders felt like they were running hard but getting nowhere. For years the economy had been growing, but suddenly things slowed down. The momentum faded, replaced by uncertainty. This isn't just about numbers, it's about families, businesses, and the future of a resilient nation. The slowdown wasn't sudden, but a gradual cooling, like a pot of water losing its boil. Strong consumer spending, a hot housing market, and high export demand had fueled growth. But challenges at home and abroad started to sap that energy. Understanding this slowdown matters. It affects everything from grocery prices to job prospects. We'll unpack the key problems: shrinking growth, rising joblessness, and why everyday life suddenly felt more expensive. We'll also look at the tough choices facing the government and Reserve Bank as they tried to steer the economy through turbulence. Inflation, interest rates, and employment are all connected. Trouble in one area, ripples everywhere. For many, this meant tough decisions: delaying home renovations, holding off on hiring, or stretching the family budget. By the end, you'll see why the Kiwi economy hit the brakes, and what it means for everyone living there. To understand what happened, let's check the country's economic vital signs. First, GDP. When it shrinks, the economy is in recession, and that's what happened in New Zealand. Fewer goods and services were produced, and the economic pie got smaller. Second, unemployment. Jobs became harder to find as businesses stopped hiring and in some cases let staff go. A rising unemployment rate meant more families facing financial stress. Third, interest rates. The Reserve Bank raised them to fight inflation, making borrowing more expensive. High rates cooled spending but also slowed the economy further. Fourth, inflation. Prices for essentials like food and rent kept rising, even as the economy weakened. Wages didn't keep up, squeezing household budgets. Fifth, government debt. To support the economy, the government borrowed more, pushing debt higher. By 2025, this limited the government's ability to spend its way out of trouble. With less room for big spending, tough choices had to be made. These 5 indicators, shrinking GDP, rising unemployment, high interest rates, stubborn inflation, and growing debt, painted a clear picture of a nation under economic pressure. Each one affected the others, creating a cycle that was hard to break. For everyday New Zealanders, these weren't just statistics. They were the reality of daily life. The economic dashboard was flashing red and everyone felt it. The government and Reserve Bank had to respond, but every move came with trade-offs. The challenge: how to restore growth without making things worse. Let's put some numbers to the story. In 2024, New Zealand entered a technical recession. GDP fell for 2 straight quarters, dropping by 1% in the third quarter alone. The year ended with negative growth, meaning the country was producing less than before. For ordinary people, this meant fewer opportunities and a sense of going backward. Unemployment climbed from 4.8% in September 2024 to 5.1% by year's end, staying high into 2025. Thousands faced job loss or uncertainty. Inflation was slow to fall. The Reserve Bank's interest rate hikes helped, but by early 2025, inflation was still 2.5%, above target. Food prices were even higher, with food inflation at 3.7% in April 2025. Even as the Reserve Bank cautiously cut rates, the cost of living remained a major concern. Government debt rose to 45.2% of GDP by the end of 2024. This forced the government to keep spending tight, offering little immediate relief. Fiscal discipline was necessary for stability, but it meant tough times for many. The numbers told a story of contraction, caution, and slow progress. The challenge was clear: how to turn things around without risking more pain. New Zealand's slowdown wasn't just homegrown, global forces played a big role. As a major exporter, New Zealand was hit hard when global trade slowed in 2024 and 2025. Big economies bought less, hurting Kiwi farmers and exporters. Geopolitical tensions and trade disputes added uncertainty, making it harder to plan for the future. At home, high interest rates cooled the once hot housing market, slowing construction and retail. The construction sector, once a growth engine, became a weak spot. Household debt was high, nearly 90% of GDP, so when rates rose, so did mortgage payments. With less money to spend, consumer demand dropped, deepening the slowdown. The Reserve Bank's medicine worked, but the side effects were painful. Global and local challenges combined to create a perfect economic storm. Facing these challenges, New Zealand's leaders had to act. The Reserve Bank's main tool was the official cash rate, kept high to fight inflation, then cautiously lowered as the economy cooled. By May 2025, the rate had dropped from 3.5% to 3.25%, signaling a shift toward supporting growth. The government, with debt already high, chose fiscal discipline over big spending. The 2025 budget kept operating spending at its lowest in a decade. No major handouts or stimulus, just a focus on long-term stability. The Reserve Bank and government pulled in different directions, one easing, one tightening. This mix of cautious monetary easing and tight fiscal policy reflected tough trade-offs. The goal encouraged recovery without risking more debt or runaway inflation. Every move was a balancing act, with no easy answers. Policymakers walked a tightrope between resurgent inflation and economic stagnation. Cut rates too fast and inflation could roar back, move too slow and recovery might stall. Businesses hesitated to invest, families delayed big purchases, and uncertainty lingered. The government faced pressure to help, but more spending risked higher debt and future costs. The choice: short-term relief or long-term stability. Fiscal discipline was a bet on the future, hoping to build confidence and lay the groundwork for growth. But for those struggling now, it offered little comfort. The challenge was to provide just enough support to avoid a deep recession, without triggering another inflation spike. Success required skill, steady nerves, and a bit of luck. New Zealand's slowdown was more than statistics. It shaped daily life. Rising unemployment and shrinking growth meant real hardship for many. The crisis exposed vulnerabilities, reliance on a few export markets and high household debt. The lesson: diversify trade, encourage saving, and build a more resilient economy. Recovery looked slow and gradual, with hopes pinned on falling inflation, lower rates, and a rebound in global trade. Risks remained. Global shocks could derail progress. The journey through 2025 was a stress test for the nation's economy and institutions. The hope that hard lessons learned will lead to a more sustainable, prosperous future. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.